Alrighty, I think this is live now. So, hello everyone. Um, I hope you can hear me. Um, because I tried to mess with the sound settings, so I think you should be able to hear me. But anyway, today is the second video for lunch lessons, and today we're going to talk about bonds and what are bonds. But first, I thought I'd give a quick background on myself for reference, or professional background anyway, just so you understand I'm not just some crazy guy talking on the internet. So after graduating from Wichita State University, there in Wichita, Kansas, go Shocks, with a double major in finance and international business and a minor in economics, I worked for TD Ameritrade as a stockbroker. And then I spent most of my career as a equities trader on an international desk. So that means I traded equities or stocks in the major European and Asian markets, as well as Mexico and Canada, and sometimes Brazil. That was a strange place to trade. And then I was also a financial advisor. And then I hold my Series 7 and 63 licenses. And I had my Series 3 license, but I'm pretty sure that has expired now. But it just allowed me to trade futures and options on futures. So I know most of this stuff pretty well. So yeah, that's why I'm doing these videos. So anyway, let's jump right in. Today we're talking about bonds and what they are. So bonds are fixed income securities, and that means exactly that. They have a fixed rate of return over the life of the security, and then of course you get the return of your principal or face value at the end of that time. Some examples of fixed income instruments are things like treasury bonds, corporate bonds, which I guess I should, well, anyway, treasury bonds, corporate bonds, certificates of deposit, or CDs. I know a lot of people's grandparents probably had CDs or would go to the bank and get CDs. I know my grandfather used to go and get a lot of CDs. Annuities are also fixed income securities. And then if you remember from yesterday, I talked about preferred stock. And preferred stock is actually a fixed income security, just because it has a fixed rate of return generally. And yeah. So a quick example, if you own a 25-year fixed rate treasury bond with a face amount of $1,000 and an interest rate or rate of return of 5%, that means for the next 25 years you will get annual payments, and generally they're semi-annual, but that's neither here nor there. Sometimes they're monthly, depending on the bond itself. But you'll get an annual payment of 5% of $1,000 or $50 every year for those 25 years, and then at the end of that 25 years, you'll get your principal or the $1,000 back, and that is essentially what all fixed income instruments look like. They just have different names and different terms and things like that. But basically, a chunk of money goes in, fixed payments come out, and then you get your full payment at the end. Quick note, generally speaking in finance, the safer a security is, or the less risk a security has, that you get a lower interest rate because of it. So there's a lot that goes into determining interest rates, and I won't go into that just because, again, trying to keep it at a very basic level. But just understand the safer or lower risk an investment is, the lower generally the interest rate will be. That holds true for your loans as well, which makes sense, right? Because you go to the bank, the lower your interest rate is, or the higher your credit score is, the lower your interest rate will be, because you're considered less of a risk than someone who has a lower credit score, which of course makes sense. If you think about it from the bank's perspective, them loaning you money is a fixed income for them, because they give you $15,000 for your car, and you're going to pay every month at a fixed rate of return for a fixed amount of period, for a fixed period, and that's coming into the bank. So for them, it's a fixed income investment. For you, it's just a loan, and sucks to have to make monthly payments. So pay off your car and don't buy a new one. No, I'm just kidding. So now you're probably thinking, okay, great. I now know that bonds and other fixed income securities have fixed rates of return. But what does that mean if I own one? Great question. I know, Marcus, it's a great question. If you own a bond, that basically means you have ownership over the debt for that company. So with stocks, you have ownership over the company, and bonds, of course, you own the debt. So you can think of it this way. With stocks, you own the profit, while bonds, you own the debt of a company, or in the case of bonds, a government. There are four main categories of bonds sold in the market, and like stocks, again, they're sold in an open, organized market, but also can be sold privately. There are corporate bonds, municipal bonds, so city governments and such, government bonds, so the federal government, and of course agency bonds, which certain agencies have the ability to issue their own bonds outside of the government entity itself. So those are the four main types. There are other types of bonds, but those are the main four you'll hear about the most. Corporate components of a bond are face value, so that is the amount of that bond. A lot of times in examples you hear, a lot of people will use $1,000 or $10,000. It makes the math easy, frankly, and most of them are issued at full value like that. But anyway, the face value is what the value of the bond is. So let's say $1,000, and then the coupon rate or interest rate is the percentage you will be paid every time they make an interest payment on that coupon, on that bond. But again, it's called a coupon. Coupon dates is when those payments will come to you. Maturity date is exactly that. When does the bond mature? Meaning when is it finished? And those can be short-term bonds, less than a year, 3 years, 10 years, 20 years. You can have 30-year bonds. So they range in maturity. And then, of course, you have the issue price, which is the amount of money you actually pay for the bond. Oh, yeah. So that's I just got a question sent to me if I still help with Boy State. So shout out to all the Boy State folks. I haven't been back. I didn't go back last year. I think I was back the year before. Just it's harder to do when I live in Texas. But there are and then there's different. So I went through and found some bonds that I actually have. They're savings bonds, but I thought it'd be cool to show since I'm talking about bonds, and let me cover up private information, I guess. So I don't know how well you can see it. Let me see if I can get back to the camera. So I don't know how well you can see it, but because this camera on my laptop is not great. But anyway, it's a $50 savings bond, and that's what they sort of look like. And this one in particular has Helen Keller on it, which I think is cool. But I can actually show you what I was just talking about in terms of the different components. So with this one in particular, it's a $50 savings bond. So this is the face value of this bond. It's $50. So that's the face value. And I have a couple of them. I just thought they're savings bonds. The interest rate isn't great. I just thought it would be cool to have bonds. I got these back in like 2014 when I first moved to Texas. It's a Series I, which doesn't mean much for most people. This shows you the issue date here, 05/2014. Oops. Yeah, 05/2014. Again, I don't know if you can actually see it, but that's when it was issued. And then the issue price, of course, for these were $50 because they are savings bonds. So all they do is accrue interest. And yeah, I just thought it'd be cool to show you actual bonds. I would show you more of it, but it actually has information on it. So there's that. So the savings bond so there's different variety of bonds, and I won't go into detail about all of them, but zero coupon bonds, for example, is what the savings bond is, in that I don't get fixed interest payments every year or every half year or even every month. At the end, when I send these back in to the Treasury Department, they'll send me a check for the $50 plus any interest that has happened, because I can't think of the word I'm trying to think of, but nonetheless, and any interest that has compounded onto the bond. And so that's how I get my rate of return. Rather than regular payments, they pay it all at the end. And I actually, just because I'm playing with different models and shit, and stuff. So we'll see. This is a zero, I don't know if you can see it, zero coupon. There we go. So face value of 1,000. Say it's a 5-year maturity. Oh, I'm over here. Sorry. 5-year maturity. And then you issue price is $800. So after 5 years, you'll get the face value of 1,000, and so you get the profit, or you get $200 back in addition from what you paid for it, and that's how you make your money on zero coupon bonds. You don't get regular payments. So that is how all of that works. And then there's convertible bonds. So yesterday I spoke about stocks, and convertible bonds are exactly that. You hold the bond, and then after a certain amount of time, you have the ability to convert that bond into stock. So those bonds are fun only because you both have ownership over the debt. It's either for a project or it's just general debt of the company. And if their stock price is doing well, or you expect it to do well, you can convert over to stock, and then you have the upside of the stock price going up. So it's a good way to sort of play both sides of the fence. Now, you'll see you get lower interest, you get a lower coupon rate or interest rate or rate of return, whatever you want to call it, on convertible bonds. So whereas a general bondholder might have a 10% interest rate, convertible bonds will have something like an 8% interest rate, just because they, from a company's perspective, since you're able to convert it, you get a benefit, and so you have to pay for that, meaning you get less of a lower interest rate. Let's see, what other bonds? Oh, so there's callable and puttable bonds. Won't go into detail. Callable bonds means the company can call those bonds back and buy you out essentially early. So if it's a 10-year bond and after 5 years it's callable, there's many reasons why they'll do it, but basically they can say, oh, we actually want those bonds back now. Basically, it's because interest rates are cheaper, so they can refinance their debt. And so they'll call in their expensive debt, reissue debt at a lower interest, and they're saving money that way. And then puttable bonds, as the investor, you can put the bond back to, that's a good way to think about it, you put it back to the company. And again, variety of reasons to do it, but basically you're saying, it's a 10-year bond, I've held it for 5 years, I want to give it back to you. You'll still get paid for it. It's not like you're just giving up all that money. But there's benefits to it. But again, basic level, so we won't go into it. So then, why are bonds issued? Like stocks, bonds are issued for the issuing company or government or entity to raise money. So you can raise money without having to give away ownership of the company. Or there's also different tax benefits for the interest you pay on your debt and bonds. The corporation or the government really has to figure out what they want to do. But obviously, municipalities and the federal government can't issue stock because citizens already have ownership, depending on how you look at the government, I guess. But we're not talking about politics. So aside from taxes, bonds are the primary way that governments raise capital. So when you hear people talk about the federal government's debt, it's because they've issued bonds. So treasury bonds, treasury notes, all sorts of securities. But again, it's all debt. And bonds, essentially, and fixed income. And that is also how, like, school districts. I know back in my hometown, a big high-profile bond issue we've done in the past were things for schools. So we had bond issues. You'll see them on the ballots a lot. That money gets raised by, for this example, schools. They then build new schools, improve the current schools, buy new books, et cetera, et cetera. And it helps in that, they can pay for stuff if it's not something that constantly brings in money. And obviously schools by themselves don't have a revenue income outside of taxes. So But then, of course, corporations have more options when it comes to raising money, like stock issuances. So, again, that's a high-level understanding of bonds. The only last thing I'll say about bonds is that generally, like I said, they're considered safer investments than stocks. It's not necessarily the case, but you do, because of the fixed aspect of it, they're considered safer. So that's why, as you age, so someone my age, I'm 29, will generally, if you look at a portfolio, will generally have a lot more in stocks, just because I have the ability to take on the risk of the variability of stock prices. So say I have $10,000 in an account, the market drops by 10%, I'm able to, over time, make up that 10%. But if I were 65 years old, looking to retire, was planning on using that chunk of money I have invested to live on, I want to make sure I preserve that capital. So that's why you'll see, as folks age, they generally will move their bond or their overall portfolio into either primarily bonds, and again, different classes of bonds, different risk classes of bonds. But nonetheless, they'll move it primarily into bonds, because again, you're about preserving your capital. You actually want to have income coming in, and you get that through the coupons or the dividends. Again, same word as we used yesterday. Same thing. The coupons are also considered dividends, will be called dividends. So it really just depends. So I think that's it. Yesterday I did have a couple questions, and actually let me see if there are any questions today. Joe asked, how can I get these bonds? Well, if you're talking about the savings bonds, these I got specifically, I was actually getting money back in 2014, which I rarely ever, it seems, get money back. And it was an option to get your money back via savings bonds. But you can actually go to any bank. Most banks should have the ability to issue savings bonds to you. So if a lot of people will do this for like their grandchildren or their children, and will buy will buy a savings bond for their child, will give it to their child, at 15, 18, 21. It depends on the bond. So this one, for example, these savings bonds as a Series I, they will continue to accrue interest for the next 30 years. So I could send these in to get money back all the way up until, let's see, these are issued in 24, so 2034, sorry, I had to do math, 2044, Jesus Christ. All right, so 2044, these I will be the last time that they add any interest. And so this would be a great gift to a child, because then, in 2044, they can go and say, all right, my dad or my grandfather bought this in 2014. It's accrued interest for 30 years now. Here you are. And then they'll get that money back. So $50 plus all the interest over the course of 30 years will come back to that child, or niece or nephew or grandchild, or whomever you're giving it to, right? So, and then two questions I had yesterday. Can you cover different websites that people use to invest? So Robinhood, TD Ameritrade, Acorn, Stash, Fidelity, etc., etc. I will do a video on those next week. Probably, I think it's on Monday, because I'm going to talk about how you open a brokerage account. And I'll try to do some level of review on those. Again, I worked for TD Ameritrade, and I have an account with TD Ameritrade, so I know it best. But I'll try to figure out some information on the rest, and we'll cover that next week. And then a question I get a lot: when is a good time to start investing? And that is, it's a longer answer, but hopefully through these videos I can answer that as well, particularly again next week, where we started talking about the hows of everything, talking about when is a good time to start investing. I will just make a quick note: now is always a good time to start investing, because there was such a pullback in the market. Of course, today is going gangbusters because of the deal that the White House and the Senate struck last night. So it's actually done pretty well today. But now is always a good time, and then anytime there is a drastic pullback in the market is always a good time to start investing, rather than at the historic highs of the market like it was previously to this most recent pullback. So again, keep sending your questions in. You can send them to me either via private message or comment on the video, and I'll try to answer them at the end of each video or respond to your private message. It just depends on the video. So anyway, this has already gone on for 23 minutes, so it's longer than I was expecting. So anyway, I will talk to y'all tomorrow. Oh, and tomorrow we are going over mutual funds, I believe. And if that's not the case, then I will let you know. Let me look. I'll just look since I'm still live. Yes, tomorrow we're going over mutual funds and what those are. So see you all tomorrow.